It's time for another Monday morning roundtable, and today I'm joined by Adam Sarhan and Roger Scott. Gentlemen, welcome.
Thanks for having us, James.
You bet. Let's start with a quick debate and question discussion about the fate of the NASDAQ 100. Certainly been the victim of slings and arrows of misfortune in the last week, but is the sell-off over, or is this just the beginning, Roger?
Well, great question, by the way. And right now, as you know, or you may or may not know, the NASDAQ 100 is in what I call the twilight zone, and you'll never hear that anywhere else. I should copyright that term. But basically, anytime the NASDAQ goes between the 50-day moving average and the 200-day moving average, it's kind of in no man's land because technically speaking, you're still bullish because you're above the 200-day moving average, but you're not really that bullish to the point where you want to go and make big momentum moves. So it kind of puts you in a position, or the market in a position, or an asset in a position when it gets there, when it kind of becomes a little choppy and loses directional bias, which for the NASDAQ 100 makes perfect sense because it's been having very strong direction for quite some time and is due to subside just a bit. So we are between those two levels, and I think we're going to stay there because the sensitivity between the NASDAQ and the long bond right now is very, very strong. And even with the stimulus, there's a huge concern about the yield, the income yield from the NASDAQ at the end of the year versus what investors are going to get from the long bond with no risk. So that's really the crux of it all. And I think we're going to stay in this environment for a bit longer, or at least earnings next quarter can come out and prove to all of us that the NASDAQ still has what it takes, that it will yield more at the end of the year, or by the end of the year, than at least 100 basis points more than the 10-year note or the long bond, and that it'll stabilize. But I think till then, we're going to be kind of in a wait and see mode, or we'll remain in this twilight zone environment.
Sure. Okay. And Adam, do you have a similar impression, or do you have a different take on that?
You know, it's funny. Roger says twilight zone. I always say purgatory. So I like to go with Roger's twilight zone. I think is a better way of wording it. I mean, Roger's spot on the money. There's no question that we're in a correction territory. What's happening now, James, in my view, is what I call the great mini rotation. And what that means is that you're seeing a rotation underneath the surface within the stock market from overbought / leading areas like growth stocks and NASDAQ 100 type names into undervalued lagging areas like basically all the stocks that have not participated since COVID last year. Enter energy, enter travel, enter, the cruise lines, the hotels, so on and so forth. So what we're seeing now is that reopening under the markets are understanding or pricing in, and that great mini rotations happening where we're moving from the stocks that really benefited during the stay-at-home world into an environment where the stocks that are taking off now are the ones that are benefiting from a back to normal world, restaurants, so on and so forth. So when you're, retail stocks, when you start seeing companies that have not participated over the last 12 months or so in this massive bull market and this massive breathtaking rally we've enjoyed on Wall Street, it's now their time to shine, because as more and more people get vaccinated, that's that COVID X I talked about, you get that number of vaccines go up, the number of cases are going down. So you have a bullish scenario for that, back to work or back to normal kind of environment. And there's so much pent up demand. And I need to be emphasize that with an exclamation mark, italics, bold, whatever, underline it, whatever word you want to use, that when the world can collectively breathe that sigh of relief, you're going to see this. You're going to see GDP growth. You're going to see the economy's booming. Travel is going to blast off. I mean, already in places that are semi-open, places like Florida, which have done a fantastic job of navigating this pandemic. I mean, fantastic. The places are packed. I mean, Disney packed at capacity. Universal, same thing. So you see SeaWorld. You go to the malls, the outlets, everywhere. Boom, boom, boom. The beaches, boom. So. And that's just from people coming in with the masks on, don't get me wrong, but it's safe to go about and do normal things. And people have been just kept up like a dog in a cage for so long. Once they get that green light, you're just going to see a massive explosion on Main Street. And that tends to be bullish for Wall Street.
Sure. So then Roger, we have earnings coming out from FedEx and Nike this week, and so is it your expectation that those earnings will have some influence or on the sentiment of investors in the tech space?
Well, first of all, let me just back up a little bit to Adam. I couldn't agree more with absolutely everything Adam said. He's 100% right. What we've seen in the past several months is a mini rotation, and the NASDAQ large caps seem to have just gotten caught up in that. And yeah, they were the biggest winner over the last several months, and now they're lagging behind all the stay-at-home stocks. Marriott, Priceline,
Hilton,
Trip.com. I'm sorry?
Hilton,
Yeah,
airlines.
Airlines, all of these stocks are starting to make a comeback. And I want to make sure people out there at home hear me out. And again, I couldn't agree more with what Adam said. My only caveat to that is don't gauge the individual stock. Don't say, well, airlines are going to go up, I'm just going to go and buy random airline stocks. You're still going to have winners and you're going to have losers within all of these sectors that are roaring back. So just wanted to add that to the mix. Now, James, to go further to your next question, yes, on Wednesday, we're having earnings come out for both FedEx and for Nike. Now, neither Nike nor FedEx is really a tech stock. So I don't think it's going to do anything at all for the tech sector directly. Indirectly, it may benefit the tech sector if the earnings are better, because then it may open, because remember, you have a lot of consumer discretionary companies with tech. So if FedEx is saying that they're doing a lot of shipping, a lot of that is Amazon shipping. And if FedEx and Nike numbers come out positive, you may see that spill over into the tech. But as a direct benefit, I don't think so. So that's in relationship to answering your question as far as the tech sector is concerned. It may bolster the argument that, hey, if earnings are really good on these two companies and people are buying and consumer discretionary and tech are really together now, they're in the same puzzle, that may lend a lot, that may spill over into the tech. But I think as far as the tech as a whole, there's just too much sensitivity right now in relationship to the bond market and to the tech for these two companies to have a major impact. And I'm just being realistic. Now, let's talk about the earnings individually and not about tech, because these are big companies and these are big consumer brands. And they have a good heartbeat on the economy, one from a retail sales perspective. By the way, we're having a retail sales report tomorrow come out. That's going to be a big report. Because as we all know, retail sales drives 2/3 of the economy. So yes, both stocks have now crossed above the 50-day moving average. They're fairly close to all-time highs. The consensus estimates for both companies are very, very solid. And I'm expecting a positive earnings surprise across the board for both brands. And technically, everything I'm saying also jives with that. So I'm expecting good things from both of these companies, and I'm expecting it to resonate positively with the overall market and reinforce that things are picking up and there is stability moving. But again, as far as the techs, on an indirect basis, yes, but I would say based on the correlation I'm seeing between the bond market, the long bond, and tech, that's where the focus is for the question of whether tech and the NASDAQ 100 will rise again will be answered when we find out if there's more upside potential or if bond yields start moving down. And that's very possible because I'm seeing divergence on the bond market. And I think ultimately, if you look 3 months, 6 months down the road, I think interest yield is going higher. But right now, we literally went in the last month from 0.95 to 1.5%. And I think we're a little overdone. I think we're going to kind of stick around this area for a while and kind of, or maybe bounce a little higher and kind of wait and see what happens with the tech stocks. But I think the earnings for the Nike and for FedEx are going to be more telling in terms of the broader economy than the tech sector.
Okay. So Adam, you mentioned that value stocks were the place to be this week. And so did you have any in particular that you could point to?
Yeah, sure. So a few areas. Number one, You can look at energy. Energy is a big component. Buffett bought Chevron a few months ago. He announced it in his 13F filings. So energy stocks, they've already had a big move. So everything I'm about to say, just like Roger just pointed out, that the bonds yields have gone so far, and they're due to pull back a little bit. So all of these undervalued areas, James, it's important to understand that they've already had a big move. But airlines, very strong action. You can look at American Airlines, gapping up big today. It's up almost 9%, but it's had a huge move over the last few weeks. So be careful not to chase it, but it's a very good area. Southwest Airlines, LUV is another one that looks good. Again, extended. Delta, DAL, is another good looking airline that's taking off, pardon the pun. And then JetBlue, JBLU, and that's up also nicely. But all of these guys are very extended. Like Roger said, 6 months out, probably higher. But in the short term, I expect these guys to pull back. The other ones that have been very strong are the booking stocks. Priceline.com changed their name to Booking Holdings. Ticker symbol there is BKNG. That's BKNG. And that stock's acting very strong. TRIP is TripAdvisor's. That's been a monster stock. It gapped up back in November near $22, $23. Now it's at 62. And it's super extended, so I wouldn't buy it up here, but it's just something that I do want to note. That's just where the strength is. And then, of course, Expedia, EXPE, is another just very strong stocks. Outside of those areas, you've got the cruise lines acting very well, Norwegian Cruise, NCLH, Carnival Cruise, CCL, and then you've got Royal Caribbean, RCL, all looking good as well.
I just wanted to add specifically to the list of the stocks that you're talking about. Marriott, you talked about the Expedia, you talked about Priceline, you talked about Trip. Marriott is in that group as well.
Yeah, great point, Roger. Thank you for that. So Marriott was actually an Alpha Trades alert given to members. We made really good money on that one. So Marriott is up there. You could put Hilton, HLT. The hotels obviously acting very strong. You've got H, which is Hyatt. Yeah, Roger, great point about the hotels. Hotels all look like they're going higher.
Interestingly, that you mentioned Hyatt and Hilton. Those obviously they're just as good, but I haven't. Maybe I just haven't looked yet this morning. But those two have not made it on my list yet. But all the other ones did. Priceline, Trip, the Expedia, Marriott. Those four have been like in the last 2 weeks really trending higher. But I'm glad you mentioned. The others, it's probably, it makes perfect sense. Good. Something for me to look at. And James, let me just answer that as well. And Adam and I actually talked about this briefly before the show today when we had our morning review. Two stocks, and this is actually really interesting. Inflationary stocks. The Chicago Mercantile Exchange, ticker symbol CME. It's near a 1 year. It's right near a 1 year high, over almost at a 2 year high right now. And that's interesting because you're seeing an influx of traders and you're seeing commodity prices rise, which is right up your alley. So CME is looking really good. And if you look at CBOE, the Chicago Board of Options Exchange, that's looking really good. They're actually mimicking each other right now, like literally tick for tick. And that's telling me that a lot of the stimulus money that's going to be coming in is going to be going back to Robinhood for people trading options. So those two stocks are doing really good. Sorry to interrupt you, Adam. I didn't mean to cut you off. I just wanted to add that because those two stocks are also.
No, that wasn't cutting off. That's accretive. So anything you can add, by all means, I'm all ears. Yeah, James, to Roger's point about the exchange stocks, super fantastic. Look, you've got record number of people trading stocks, record number of people trading commodities and futures and all that fun stuff. So for me, all of the exchange stocks, you've got CBOE, like Roger mentioned, the CME, the Chicago Mercantile Exchange, where they trade futures. I would also add ICE, and NDAQ, which is the NASDAQ, to the list. And those four, CBOE, CME, ICE, and NDAQ, stand to benefit not only from record demand in the stock market, guys, but also from all the stimulus money that's being announced. We just had a huge stimulus package, another one. And the first two ended up in the stock market, big portions of them at least, and other markets as well. The Feds told us they want inflation. So all that bodes very well for the exchange stocks.
Sure. So talking about the inflationary pressure of quantitative easing, and we look at the record-setting trend in commodities prices alongside the still yearning slightly higher, though paused at this level, as Roger said, the higher 10-year yield. Is this all sort of indicative of a more inflationary future where we're going to see more money moving into commodities? We've already got oil on the rise. Gold has certainly sort of locked in a reversal in its performance in the last few sessions. Is it time to go all in on commodities?
Well, I don't know if it's time to go all in on commodities, but there's definitely signs of inflation. I'm almost certain that that yield on the long bond is going to be going higher. And interestingly enough, by the way, remember we're having FOMC this Wednesday, so it's going to be very interesting to see what the Fed says about that, because that's obviously the biggest concern for investors outside of COVID and the stimulus right now. I'm fairly convinced that it's time for interest rates to go up. It's inevitable, especially in light of the economy, in light of what the country went through. The only question is the economy going to sizzle at the same rate as the long bond? Are we going to is the economy going to heat up so that we don't have too much of an inflationary pressure? But I think ultimately it's healthy to have a little inflation. I don't think it's that bad. And I think that commodity prices are set to rise. I think it's going to be a multi-year rally. I think interest rates by the end of this year, the long bond is going to be at about 2.5%, maybe 2.25%, 2.5%. And I think this is very, very normal. But in terms of seeing a gold market double in size from where we're at right now, I'm not so sure about that. I think it's going to be more towards industrials and material commodities and not in precious metals, at least not right now. I think that may happen later on in the economic cycle, but I don't think we're there just quite yet. But I do believe we're going to see inflationary pressure on commodities. I'm almost certain of it. And that's what the bond market's telling us as well.
What's your sentiment towards commodities, Adam?
Yeah, I agree with Roger. I would also add a few other points. The first thing is to keep in mind with commodities, they don't trade like stocks in a typical sense, meaning for the most part, outside of April of last year with crude oil, commodities can't go below zero. I mean, the worst thing that happens here is you don't have a commodity go to zero. They don't go bankrupt is what I'm saying here. You don't see corn go bankrupt or soybeans go bankrupt or oil go bankrupt. Now, individual stocks that trade commodities, those guys could go to zero, sure. But, historically, outside of that one blip last year, because of the roll in crude oil, which briefly took crude negative, and it wasn't even a thing if you held it for longer than that. But commodities don't go bankrupt. So understand there's always value in commodities. People have to eat. Sugar, coffee, even the agriculture stuff, right? The softs, OJ, all these commodities have intrinsic value. Now, the value changes based on supply and demand and based on economic data and the growth and all that kind of fun stuff. But the Feds told us they want inflation. That means commodity prices are going higher. Now, if you step back and look at the last 6 months, commodity prices have already gone higher. So they've had a huge move. Now, coming in and buying right now blindly, just saying I need to allocate to commodities, wouldn't, as a blindly just a huge thing, wouldn't be the best thing to do. But as always, pick your spots. Something like corn looks great on a technical basis. Fundamentally, the case makes perfect sense. It's sitting right off the 50, had a nice move, consolidated that move, ready to blast off again. The other side of commodities, guys, to pay attention to is the government. Biden's made it very clear. I think he had a headline cross this morning I read somewhere that there's going to raise taxes to fund infrastructure and other projects. Well, what happens when the government becomes the largest buyer of commodities? The commodities are going to go up. It's just that simple. So copper, you look at, like Roger had mentioned too, the other stuff where there's an industrial purpose to it, that stuff tends to go up. And you're going to have, as the economy continues to, get back to normal and grow, you're going to have more demand for food and energy. And that's the core prices of, food and energy are the core part of CPI or inflation data for the Fed looks at. So if food and energy prices go up and then you see other commodities going up as well, like copper or other commodities that we don't even talk about, then all of a sudden the entire commodity complex could do what it did about 15 years ago and enter a super cycle where all of a sudden everybody wants to jump in on commodities. So obviously it's a very important area. It can't go bankrupt. It doesn't go to zero. It always has value. The value changes, but it's definitely something that I would recommend most people pay attention to and allocate to. And the allocation changes depending on your review and where we are in the cycle, so on and so forth. But I think commodities is an absolutely fantastic place for people to be investing in at the right time.
And I just wanted to add some perspective, okay? As Adam was speaking right now, I just happened to pull up the CRB index chart. The CRB index is a index of different various commodities, and the CRB index made about a 17 or 20-year low in February of 2020. Okay, a multi-decade low. And right now, it's sitting right at the cusp of breaking out above a 5-year high. So if we go a little higher, we're right now at about the 206 level. If we can break above the 210 level, we're going to be at a 6-year high, 5.5-year high on commodity prices. And I'm seeing this breakout continue. So I believe that we will definitely see higher commodity prices, especially based on the CRB index. And for those of you who are interested in measuring commodities as a whole, the CRB index is a great tool to do that. And you could just type in on Google, go to CRB index chart, and it'll pull up the CRB index. It'll give you a really good view of the whole of a broad commodity market, kind of like a S&P 500 fund for commodities, if you will.
All right. That's great, gentlemen. Interesting week ahead. Thanks very much for joining us. We'll see you both at the end of the week.